Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. We've got an update regarding Canada's inflation numbers. We've got some comments from Canada's largest bank on what's happening with their mortgage book. We've got some comments from policymakers around immigration and their plans to sort of curb it. So we're going to walk you through all of that this week, but I'll start off with the inflation numbers. We've been following it on this channel for the last couple of years. Of course, everyone in Canada watching those numbers, hoping they come down so you get some relief from the Bank of Canada. But that was not the case for this latest inflation print, coming in at 3.4% on a year-over-year basis in the month of December. So an uptick. The expectation was for a 3.2% headline growth. Again, you hit 3.4. I think the larger concern was the stickiness in core inflation, which kind of strips out those more volatile items such as gas and food prices. And so the core inflation is still sticky, still kind of stuck at 3. And so that last mile getting down to that 2% target is proving to be a challenge, which I don't think is unexpected. What I will say is that the Bank of Canada is out next week with a rate announcement. Again, expected to be an ongoing pause, ongoing hold. The reality is you can't spend too much time focusing on one inflation report number, right? We get a new report every single month. 1 month does not make a trend, but it does show that, hey, you know what? Things are stickier than expected. And this is playing into the rates markets. You remember as we came into this year, bond yields were tumbling. Sentiment was going super ecstatic about Bank of Canada rate cuts. Everyone's saying, oh my gosh, how many are we going to get? When are we going to get them? But they're certainly coming. Sentiment starting to improve. And you're seeing a lot of that now being sucked out over the last couple of weeks as the data comes in a little bit hotter than expected. It's providing less wiggle room for, again, the Bank of Canada. And this is particularly strong data out of the U.S., which is pushing bond yields higher. So, for example, the Canada 5-year bond yield, right, which is what we follow quite closely for pricing 5-year mortgages in this country. I mean, it fell over 100 basis points over the last several months. And this year alone, to start the calendar year, we're up 30 basis points. So the free fall in mortgage rates is largely coming to a stop. Now, what I will say, it's been a big move nonetheless. We saw, 3-4 months ago, you had a 3-year fixed rate, which is kind of what everyone's taking. You're looking at about a 6.2, 6.3% rate. I've got clients getting 4.99% with some lenders on exceptions, but you're seeing most of those kind of around 5.3, 5.4. And, for those people that are asking, well, who's the 4.99? I mean, that's one of the benefits that you get with working with myself and my real estate team. So again, we're always happy to have that discussion, but they are out there. You got to know the right people. But obviously that 4.99 is a big deal. I mean, going from 6.3 to 4.99 makes a big difference on $1 million mortgage in this country. And so the 30 basis point move that we've seen this year is going to largely wipe out a lot of the free fall that we've seen in rates over the past 6-8 weeks, which kind of leads us into some comments that we had this week from RBC's CEO Dave Mackay. Keep in mind, we've talked a lot about the mortgage renewal wall, right? And so that's something we're still watching. There's a lot of Canadians that have yet to be impacted by rising mortgage rates, right? Their mortgages that they've locked in, they haven't yet come up for a renewal. And so there's still a lot of Canadians that are waiting for that payment shock and how that's always going to play into the larger, bigger picture. So let's clip into Dave's comments right here.
First to tell you, exactly, yeah.
Dave, I want to finish on housing. I have to say, I'll speak for Lisa and me.
Yeah.
When rates went from 0 to 5, when we saw rate hiking cycles in places like Canada, the UK, and even Australia, we were both thinking about what on earth is going to happen to housing markets? Right. Where does that leave the banks? I was thinking about that with regards to Canada as well. What is happening?
So there has been a payment shock to Canadians, and the difference between Canada and the US is we don't have a 30-year fixed mortgage. We usually have 4 or 5-year terms. So we have a lot of variable rate mortgages at the same time. 20% of our book roughly is variable rate mortgage. So you've seen a payment shock to about 30% of Canadians right now, in the tune of 20 to 25% increase a month, $400 or $500 a month increase. So that's been challenging for Canadians. What it does is it slows the economy much more quickly. Unlike the US, where there is no payment shock really unless you break your mortgage or sell your house. So the US economy struggled to slow the consumer. The Canadian economy has slowed the consumer quite significantly, and we've seen that in the credit card business. People have a mortgage, people have a variable rate mortgage, credit card spend is off. Canadians are handling that payment shock well, so you're not seeing that migrate to default, but you're seeing the Canadian economy slow much more quickly to the point that we already have a quarter of negative GDP under our belt. We're looking at probably another negative quarter of GDP. We'll technically be in a soft landing recession early this year. So Canada's slowing more quickly. Inflation's still a little bit sticky, around just above 3%, but there's still 70% of that book is going to reprice over the next 2 to 3 years, and 15% this year, 25% next year. So unless we get rates down, there's more payment shock coming, but consumers are handling it.
That's one to watch.
So Dave talks about something like 70% of their book is still waiting for a mortgage renewal over the next couple of years. Now, that's RBC's book. I can't comment specifically on their book, but the market as a whole, if you look at the big 5 Canadian banks, the number is closer to about 55% of the market. 55% of people that have a mortgage in Canada are still have not been hit with a payment increase. So it's not quite the 70 that RBC is talking about, but the market as a whole, basically, there's still a majority chunk of Canadians that haven't been hit with a payment increase. And to further on Dave's comments, he talks about the Canadian consumer. They're seeing it, with their own eyes in their, their consumer spending, their credit cards, etc. We saw that with some data that came out this week for retail spending here in Canada. The number for November down 0.2% on a month-over-month basis. That follows a similar decline that we saw in October. Retail sales for a healthy economy are not supposed to fall, right? I mean, if you think about it, right now, you have 0.2%. This is not even accounting for the population growth. And keep in mind that Canada's population growth is running at nearly 3% on an annualized basis. And so when you start saying, well, we're declining despite adding, the most amount of people that we've seen in over 70 years, it really kind of shows you that the consumer is pulling back. Yes, they aren't defaulting on their mortgages today. What they're doing is they're stopping their spending or slowing their spending on other items in the economy in order to service those higher mortgage costs. And again, keep in mind, more than 50% of the market has not yet seen a payment increase. So long story short, I think you continue to see the Canadian economy slow over the next 12 months. I know everyone's sitting there waiting and talking about recession. Again, I would argue in Canada that we're already in one, regardless of what's happening over in the US, which continues to be the strongest economy going. So you've got retail sales, and that's kind of what's happening in the bigger picture. So kind of how we're watching the housing market right now, so early, 2.5 weeks in, it's much too early to draw conclusions. I will say, again, sentiment has improved. Things are selling much quicker. It's much too early to make that call because it really just depends on the trajectory of where interest rates are 1 month, 3 months, 6 months from now. And I still think this is going to be an incredibly volatile year for housing because the markets are just sitting there and moving in wild directions on every single data point. So keep your eyes on that. The other thing I'd kind of mention, we've talked a lot about on the show is the immigration picture, right? I mean, 1 million plus people a year coming into Canada. What is the federal government doing? Well, we've been talking about immigration for several years. In fact, my colleague Rich Diaz, was talking about it, over 4 years ago on Twitter, posting charts that are now circulating from mainstream economists He was putting those charts out 4 years ago, and the government basically ignored the problem, including their own policymakers that warned them 2 years ago. And so it was like a couple months ago, we had the immigration minister, Mark Miller. He came out and says, limiting international foreign students would be like performing surgery with a hammer. And now here he is a couple months later saying that there is a proposal that they are working on behind closed doors. This is according to the CBC, that the Liberal government is looking at limiting and restricting foreign and international students in select provinces across this country, particularly mentioning BC, Ontario, and Nova Scotia. So we'll wait and see. As of right now, the federal government is only considering, but the fact that this is now being picked up by CBC News, there's internal rumblings. Clearly, the government is strongly considering caps on international students in these three provinces that are in the midst of significant housing crisis and infrastructure crises. Just to give you some context on the numbers, I mean, it is truly mind-numbing, the fact that this is persisted. There's some good numbers out from Mike Moffat this week, and showing that, as of right now, we've got the data for the first 3 quarters of 2023. So we'll have the Q4 numbers coming out very, very soon. But for Q3, right, I mean, it's a 9-month period. Non-permanent residents, which is basically foreign students, temporary workers, we admitted 654,000 students. 654,000 students in 2023. In the first 9 months of the year. The average between 2017 and 2022, right? I mean, pretty significant period there. We got a good bit of years to sort of assess to, and we're at 138,000. So we increased them basically almost sixfold this year alone. The average between 1999 and 2016 is 54,000. So we went from 54,000 to 138,000 to 654,000, and people are wondering why rents in this country are up 22% nationally, 22% over the last 2 years. And so I wanted to sort of unpack this a little bit more because it's quite important to get some comments and stuff. I get a lot of feedback. I like to read a lot of it because I like to understand how people are thinking and reacting to certain pieces of information. And one of the comments I hear a lot is, Canada's a housing bubble and there's no supply problem. I would certainly argue that we have many, many elements of a housing bubble. I would call it a credit bubble, an excess buildup of leverage that has inflated house prices. However, I will say this, that the rental market is a function of supply and demand, right? Like, you can't go to the bank and be like, I would like $100,000 because I need to pay my rent for the next 2 years. Please loan me some money. You pay your rent based on, your job, your income, and it's supply and demand. How many units are available on the rental market? And if there's very few, you can push the rental asking price higher. And so despite the fact that house prices are rolling over across the country, other than maybe Alberta, right? Prices are declining because the availability of credit, aka how much you can borrow, has become more expensive. And as it's become more expensive, your ability to qualify, you qualify for less debt. And so it becomes difficult to support the valuations in that environment. We see mortgage credit growth running at 30-year lows in this country. However, so house prices are declining because that's a function not only of population growth but of credit growth. You need to be able to borrow money to support the valuations. However, the rental market is a function of strictly supply and demand. So that to me tells me, if we have rents growing by double digits every year, I think you have a mismatch in the number of homes that are available on the market and the demand for those homes. So I think you can unequivocally say that you have a supply issue. And so until rents are declining, and not declining for a month or 2 or 6 months, I'm saying declining in a meaningful period of time, let's say over a 1, 2, 3 year period, I'm not convinced that you are oversupplied or that you have enough housing, right? I'll give you a story. If you follow the Calgary market, something where I actively invest in, and this is perhaps a important reminder for people that live and invest in places like Vancouver and Toronto. In markets like Calgary, there are periods of time where you can see no rent growth. Zero rent growth for 3, 4, 5 years. In fact, you will see declining rents, like we saw it from the period of basically 2015 to basically 2019, flat to declining rents. People started the availability of homes. Yes, the economy softened, but the availability of homes, Calgary built a lot more houses. The economy slowed. And rents actually came down. So people what they would do is they would leave like their basement suite because that was all they could afford at the time. And they would be able to then go and rent like a nice 1-bedroom apartment in a newer place, get a month's free rent, free internet, because there was availability of supply. And we don't have that in most markets in Canada, and particularly in the big hubs of Vancouver and Toronto, where again, I think you do have a chronic shortage of housing. And so I think that's an important context when you put all of this together. Rents and resale prices can deviate because they are playing off of different symptoms. So focus on that as we look towards mortgage rates, rents, and how you're factoring that as an investor. You always have to prepare for various scenarios, particularly in this volatile environment. So that's kind of how I'm watching things here early on in the early part of 2024. Sentiment is much improved, but we'll see how the data shakes out. I think as you get bond yields rising once again, that can slowly filter into mortgage rates and begin to change sentiment. Again, I would argue if you get mortgage rates, back into the 5.5, 5.8, back into the 6s, you will see the housing market slow. It is what it is. And so continue to keep a close eye on the bond market. And as always, we'll see you next week.
If you're looking to buy or sell real estate in Vancouver, don't hesitate to reach out. I'm happy to have a one-on-one consultation. Sometimes had people say they didn't reach out because they were nervous, or they thought I was too busy, or they thought I was just a talking head on YouTube. But in fact, I help people buy and sell real estate in Vancouver every single day. My team is in the top 1% of realtors in Greater Vancouver in terms of sales volumes. That's 14,000 plus realtors in the entire Greater Vancouver area. So again, don't hesitate to reach out. If you want to do that, there's a link in the description where you can book a 30-minute calendar consultation. We can have a conversation. I can walk you through how we work with our clients as a trusted advisor in some of the biggest decisions of your life. And so happy to have that conversation.